Three, two, one. So, if you are looking for a systematic way to find alpha in equity markets, a way to beat the market, a way for your long portfolio to outperform your short portfolio, you need look no further than that of investment styles. I'm going to talk to you in this video about investment styles on the JSE. I'm going to show you up to 34, sometimes 36 years of history of investment styles. I'm going to show you different investment styles, and I'm going to show you a sort of if this, then that approach. So we want to group shares by certain characteristics. We want to group shares, for example, large shares, and we'll group shares short, small shares. And we want to see if the size of shares has anything to do with their subsequent performance. So just to get us started, I want to talk about Eugene Farmer and Kenneth French, two professors who introduced us to efficient markets and the capital asset pricing model, very famous guys. Anyway, once they'd published their research, some of their students came to use computers to actually test out some of those theories, apply empirical studies. And the first one was, of course, size. And that was discovered that size makes quite a difference. This is with the backdrop of efficient markets. And then another student came along, a student of Farmer and French's, and he showed that low PE, stocks with a low PE, a low price to earnings multiple, those stocks outperformed those with high PEs. So I've taken these two styles, size and value growth style of high PE, low PE, and I've added to that something particular to our South African market, which is resources versus non-resource type stocks. So mining versus, on the other side, industrials and perhaps financials. So let's get started. Let me see if I can get this to a full screen. Here we go. And I have started us in 1986, and I'm going to take 160 shares, the largest 160 shares, typically what's in the all share index, and I'm going to allocate each share to a particular portfolio. So I'm going to say, is your company large? And if it is, I'm going to put it into L. So you see the L's here for large, and then the M's for medium, and the S's are for small. I'm then going to ask you, are you a low PE or a high PE? And if you're a low price to earnings share, I'm going to call you value. Otherwise, I'm going to call you a growth. And finally, I'm going to ask you, are you a resources share or a non-resources share? So we've got 12 portfolios here. And once we've allocated the portfolios, we're going to run them for 3 months. And after 3 months, we're going to reallocate. We're going to rebalance and make sure that we maintain the style. So this big red line here, that's going to be a portfolio that must always have large, always have value, the low PEs, and always have resources stocks. If something fails to fit into that category, it's going to be moved. It's going to be removed and moved into a more appropriate category. So here we go. It's down in 1986, 34 years ago, we start with a rand in each portfolio. And you can see the black line is to keep us honest. That's the all share, all 160 shares put into one portfolio, but every other one has got fewer shares. You can see that what decision was a good idea, and it was probably a good idea to invest in value resources stocks. In fact, whether they were mid cap or large didn't seem to matter, but here is a 21-22% return. That's per year on average since 1986, compared to the all 160, which is sitting at like 12.6. These are all equal weighted, by the way, and have their dividends reinvested. The opposite end of value resources, look down here, is growth. Okay, growth resources. So the larger ones, large value. At the bottom here, we've got a small growth. So still in resources, you can see small growth is typically a terrible place to have been for the last 36 years. So it's amazing that just by looking at three decisions, your size, your PE ratio, and whether you are in resources or not, those three decisions have given us a range from, let's go at the bottom, minus 4.7 all the way up to 22. And if we can explain, if we can create a range that big, then it's most likely that we are talking about styles. We haven't looked at technical analysis here. We haven't looked at companies' balance sheets and income statements and cash flow statements. We haven't gotten interviewed management. All we've done is say we are going to always have large value resources in the red one. And if you invest in that, that's what you would have got so far. We have to be careful though, because this big fat red one, although it looks like it was the best, if you go back down here to 1998, you'll see it was actually one of the worst. So we are actually looking for persistent styles, and we're not always going to get them. So let me show you some others. I'm going to flip across to there are a whole lot of things here, but we haven't got time. But I'm going to show you here this thing called earnings yield. I'm flipping out of that main full screen because the mouse just won't work nicely. So earnings yield, this is the opposite, the inverse of PE ratio. We take the company's earnings and we divide by the price. And this is one where typically and generally earnings yield has tended to outperform. What's important here when we take one particular style, it's important that I tell you that we've taken 160 shares and we divide them up into 5 portfolios. And you'll see 1, 2, 3, 4, 5. And 160 divided by 5 is 32. So each portfolio has 32 stocks in, equally weighted with dividends reinvested and rebalanced every 3 months. So if you step back here, you'll see, wow, the blue stuff, that would be a great portfolio for my shorts, because that only went up on average 5.7% per year. Whereas the other portfolio, still of earnings yields, but the highest earnings yields, those 32 shares went up an average of 17. Now you don't need a t-test, any stats to tell you there's a difference between 17.5 and 5.7%. So look at all the stuff in the middle, and it's nice when they go in order, 1, 2, 3, 4, and then 5. Okay. Well, we always want to see that the gap between red and blue is increasing. So when we divide the red by the blue, we get this relative line. And you can see relative line is generally going up, though not always. Okay, and it's had an average outperformance of the first quintile versus the fifth quintile of 11.1% per annum. It's on average, and there are times when it goes down, as it did last year, 2015, 2008, 1998, etc. So this might be a good one to write down. In general, you want companies that have earnings yields that are in the top quintile, the top 20%. We can plot this. We can plot these portfolios 1, 2, 3, 4, 5, and I'm actually showing you the earnings yields. You can see the earnings yields for our best performer here range from about 20% at some stages, right down to 10% at others. But in general, we're talking about a 12%. 12% earnings yield is just the sweet spot to be. Well, unfortunately, earnings, accountants make these things up, come up with them, and perhaps a better one is to look at dividend yield. Dividends are actually paid out of earnings and into the investors' bank accounts or broking accounts, and so this might be better. And you can actually, this comes out even better. We see that companies ranked by dividend yield, the top dividend payers, the top 20%, have outperformed the bottom by about not 11.1 but 10.4. And interestingly, instead of this sorry, I can't compare. This is only to 2018, but the important thing here is that this green line looks similar to the earnings yield one, and it is going up. Not all companies pay dividends, so I didn't expect this to have as solid an effect, but it had a better one from the sense that this went 1, 2, 3, 4, 5, monotonically increasing or decreasing effect. Dividend yield. Dividend yields, you can see here plotted from 2%, 4%, 6%. So we're looking for anything at least more than 4%, sometimes as high as 10, but we want typically in the 6% range. Right, I'm going to flip through a couple here to show you some different effects. Balance sheet effects, a return on capital. When we plot out, here I've called them from very high down to very low return on capital. And it's quite amazing from 1986 until 2011 here. Wow, our top 4 were hardly distinguishable. The only one that was different was the blue one, was our very low return on capital. So instead of looking for alpha here, we're looking for something to avoid. We want to avoid stocks that have a very low return on capital. So sometimes it's not what you want to be in, it's what you want to avoid. So how about a return on capital? I think this one's a bit more updated. Yes, it is. Instead of 2011, it's 2018, and it's very much in place. Return on capital 1, 4, and 3 and 2 are similar, but this one is egregiously different. You want to avoid stocks with very low returns on capital. This is showing the actual return on capital, 12 monthly, year on year. Lines never cross because we always are ranking by this characteristic, but we want to avoid anything that is from 5 and below, it seems. 5% return on capital. Well, instead of return on all capital, we can just look at return on equity. Here's an interesting one. Well, high ROE, that didn't do so well. Oh, maybe it's the low one, the blue one. No. What is this brown one here? Brown one, brown. That's the middle one. This is what's known as a non-linear style. It's not the high ROE or the low ROE, it's the middle one. It's the Goldilocks effect, the one where it's just right, a sweet spot. Maybe high ROEs have too much gearing. Maybe low ROEs don't have enough RONA, if you're looking at the DuPont equation. So sometimes we're looking for a sweet spot. What is that sweet spot? It was the third one, wasn't it? That middle one. So here it is in green, and it's showing you that a sweet spot is a ROE of around about 20%. Well, the original value growth metric used to distinguish value and growth was this price to NAV, or price to book value. And look at this. It shows that companies with very low price to books, you're paying a low price for a high book value. Look at that. Look how well they've done. And companies with a number one with the highest price to book, they've done worse. But you've got to look more closely than this. When I divide the red line by the blue line to get the relative, this line, look, it's working. It goes down, but around about 2004 to 16 years ago, this effect stopped going down and went sideways. It's almost as if it was found out. So there's styles that used to work that don't work anymore. Another risk measure is how much interest cover one should have on your income statement. How many times should you be able to pay your interest from your pre-interest income? And so the ones with the highest cover are the least risky. They don't seem to do the best. How about the ones with the lowest cover, the lowest interest cover? Okay, those are the ones that could be in trouble. Well, they certainly are. They've done the worst, 12%. But it seems that here's another sweet spot. Look at this. Interest cover 2 and 3. That's like a full 40% of the market is sitting up there and outperforming. You want to be long those ones and short the very low interest cover. I wonder what those interest covers actually are, 2 and 3. Next slide, you'll see here I've plotted the interest cover, and we're looking for 2 and 3 between the pink and the brown. Anywhere between 5 and 14 currently. It might be sort of 8%, 8 or 9%, which is actually not what I would have guessed. I would have guessed like 5 or 6, but this is showing you that companies that are very conservative and want 8 or 9 times cover seem to do the best. How about actual cash flow? Cash flow in the financials. Cash flow to price. Look, this one. Look, it's quite intuitive. Cash flow to price. The ones with the highest cash flow to price have given us the highest returns. Ones with the lowest cash flow to price, the lowest returns. 17% plays 5.7%. When you divide the red by the blue, here is, it didn't work for quite a long time, but since 1998, it's really worked quite nicely. 2009, 2010, it's been a bit flat. All of these styles, which ones should we go for? Which ones do we have to go for? Sometimes you find a style that is completely unintuitive, counterintuitive. This one caught me out. This is a liquidity style. I would have guessed and bet that if you took the actual value of shares traded divided by their market cap, the shares that traded the highest proportion of their market cap every year would do better, the well-traded stuff. And the stuff in blue that is the least traded, that would do the worst. I tried and tried and tried, but whatever I did, I found that the most traded did worse and the least traded did best. Only when I went and sort of did some research did I find my friend Amihud, who had discovered this in the early 80s. And it's been documented as an illiquidity premium that you get, that you seem to be rewarded for by buying and investing in illiquidly traded companies. How about that? Value traded. Here's an interesting one. This is capex. Do you think companies that are capexing, capital expending more than usual or more than other companies, do you think they would do better or worse? Maybe the directors know something's coming and they're getting ready for it, gearing up. Well, it turns out that the market hates companies. It hates companies. Here we go. Asset growth, quintile 1, the highest growth in the last 2 years. From year 2, 1, and 0. If you invest in companies that have been investing heavily or more than usual in the last 2 years, they do terribly. But if you go to the asset growth, the lowest, quintile 5 asset, the lowest asset growth over the 2 years before that, from 4 years ago to just 2 years ago, and turns out that they'll have very little more recently, you can get up to 14% per annum. But what I really like about this is that if you go long the blue stuff and short the red stuff, like we should in our hedge funds, look at this green line. It goes just tick, tick, tick straight up every year. It's delivering 8.5%. It's hardly ever had a dip down. This is the style that you should have some exposure to. Right, this is momentum. This is something that you perhaps shouldn't tell people that you are using because it's just so easy. Momentum, this is when you look at a share's price performance over a past period, in this case 1 month. We're hoping that if shares that have done well in the last month, they'll continue to do best in the next 3 months. Well, it didn't work out here. Shares that do well in the last month tend to do pretty poorly in the coming month. So they did well, but they're actually still doing poorly. This is called the momentum, a reversal, the 1 month reversal phenomenon. But it does turn out that if you invest in shares that did terribly last month, they're going to do terribly in the next 3 months. That is for sure here. Well, maybe 1 month is not a long enough period to look back. Maybe if we'd made that 3 months. Look, it went from 1 month to 3 months, and that red line starts to move up a bit. And the blue line stays bad. Bad for 3 months, you're going to be bad for the next 3. Good for 3 months, you're going to be pretty good for the next 3. Let's make that 6 look at this now. Wow. I'm starting to see a big difference, 23% versus 4. For my hedge fund, I'm using momentum. I'm going to have low momentum in my shorts and high momentum in my longs. Look at that. And look at this green line. This green line is showing a relative between quintile 1 and 5 of 17% per year. Let's make that 9%. I'm on a roll. Let's make it 12%. Does it keep going? 15. Hey, oh, it's getting worse. Go back to 12. There's a sweet spot around between 6 and 12. Now we're getting 23% per year. Dividends reinvested, no costs applied. And stuff that's done worse than in the last 12 months, it will, on average, give you 3.5% return, and only 3.5% return. So for our hedge fund, if our shorts could we borrow the stuff and sell it, it's only going to cost us 3.5% on average per year. That's a very low cost of capital, especially when we can invest that capital, having sold these shares, we can invest it in something growing at 23.6. That's crazy. So many momentums. I'm hoping that if we plot the 1 month, 3 months, 6, 9, 12, you can see a progression here. It gets better, 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 and then it gets worse again. So anything from 6 until 12 is an optimal look back for momentum. Sure, look at all these styles, different returns that we got, different green line spreads between first and fifth quintile. So just for fun and for a conference years ago, I said, let's just take 4 of these. Let's make a combined style. I want companies that have a good return on capital, companies that have a high cash flow to price, companies that have a low earnings yield, companies that have a high 12-month prior momentum. Let's rank by those 4 things and by the sum of those 4 things and invest in the top quintiles. Let's see what we get. And here you can see, wow. So this was the South African Finance Association. I think we presented this in 2011, actually. So we've had a few years since then. And here you can see that the red line, quintile 1, it's come off recently, but the blue line has also come off. So the hedge fundability, the use to hedge funds is the green line, is sitting at 20.5%. Been a bit flat recently, but it's still up there. This, of course, is 160 stocks, and if you're a big fund, you probably can't invest in the 160th stock. It's too small. So if we rerun this, maybe take off the 1, make it only 60 stocks. We want to see if the effect is still there. And I haven't updated this, but you can see 25% per year plays 6.5. And if I take off another 20 and be left with just the top 40, the effect is still strongly there. What about, I haven't spoken about this risk story. I've left it for last, because one of the basic tenets of finance is that the higher the risk you take, the higher the return that you should expect or demand. So this vol here is volatility. It's the standard deviation of daily returns in the past. And we really expected that shares with high volatility should give us high returns. Oh my goodness. 1, 2, 3, 4, 5 monotonically turn out the wrong way. There's a big difference between getting 5% and getting 18%. And if I divide the red line by the blue line to see if this gap keeps on opening, look at this green line. This shows me that my high volatility shares are losing 10.7% on average per year against the low volatility shares. It's exactly the opposite. The higher the risk, the lower the return. And this is since 1986, it's 34 years on the JSE. Now, some people complain that it's not total risk that matters, it's only market risk, because you can diversify away a lot of idiosyncratic risk, company risk. So if I replace volatility with beta, which is a measure of market risk, should work now. This should work. You see, what? High betas, 1, 2, 3, 4, 5. High betas give the lowest returns, and low betas give the highest returns. Look at that. Since 1986. This needs to be updated a little bit. It's 2016, but wow, that's pretty damning as far as I'm concerned. Wow. Wonder what the betas are. What's the average beta in here? What's the average beta in here? Maybe there's a plot here. You can see what the betas are. Look at these. 0.3, point. But wonder what can't we combine these and show beta versus return? Okay, let's do that. And so we're going to plot the beta on the x-axis and the annual return on the y-axis. The slope is very negative. It's showing that high betas, 1.3 beta gives a 6.7% return. And if you go low beta, you're getting nearly a 19% return over those 34 years. Pretty damning, isn't it? That line is quite well fitted. Higher betas give lower returns. Well, for those who think that 5 data points isn't good enough, I've converted this into deciles. So I've got 10 data points. I reran the whole analysis with deciles. And so I'm still plotting here. With a 1.3, I actually can get a 1.42. It's quite a high beta. And those return just 5% over 34 years. And as we lower our beta, so we get higher and higher average returns. CAPM has shown to work backwards. I've even plotted in here some risk-free type measures. Because CAPM says you should start here, and there should be a line moving up to the top and right. Actually, our line moves from the top left to the bottom right. So I'm showing you this, but we can prove this through styles. And here is we've got a style that says you want good returns, invest in low betas. So bet against beta. Right, I think that about sums it up. Are you ready? Did you make some notes of which styles work? If you go to Google and you search for Muller space Ward space SSRN, it'll take you to the Social Sciences Research Network, SSRN, and up will come a whole bunch of research that we've published, and one of them will say Styles Graphical Time Series Approach, and they'll have all the write-up and the graphs that we have included in this particular presentation. So go and take a look. So now that we know what styles to use, we are ready to move on to our style slicer. So that's going to be our next video, the style slicing. Thank you, and we'll see you then.